All right, fellow AMC stockholders and meme stockholders, XMAX Trading here. I want to thank all my new subscribers to my channel, and we're growing the channel. So if you haven't subscribed already, think about doing that. We can keep the content rolling, and hit the like button, and let's get started. So I thought it was an important DD to go over about the failure to delivers. Dr. Susan Thornbrad, whatever, I can't remember her name. Sorry, my bad. But people keep saying that the short interest, the short interest is down on AMC. The short interest that, and what she was saying is the FTDs may be more important than the actual short interest itself. Because sometimes that short interest, it'll go up, right? So we think the short squeeze is coming. Then it kind of dips down. And then sometimes that's when the short squeeze happens, or it doesn't happen sometimes. But she was saying, I think other people were saying as well, not financial advice, the FTDs are the ones to look at. That's what has to be erupted for the shorts to buy back, So let's look at what is a failure to deliver. Failure to deliver, FTD, refers to a situation where one party in a trading contract with its shares, futures, options, forward contracts, doesn't deliver on their obligation. Such failures occur when a buyer, the party with a long position, doesn't have enough money to take delivery and pay for the transaction to settlement. So the buyer does not have enough money. A failure can also occur when the seller, the party with the short position, shorting is when you're selling, going long is when you're buying something, does not own. So a failure can occur when the seller, the party with the short position, does not own any of the underlying assets required at settlement and so cannot make the delivery. They can't make the delivery at all. Failure to deliver refers to not being able to meet one's trading obligations. In the case of buyers, it means not having the cash. Sellers, not having the goods. You got no goods. The reckoning of these obligations occurs at trade settlement. Failure to deliver can occur in derivative contracts or when selling short naked. Understanding failure to deliver. Whenever a trade is made, both parties in the transaction are contractually obligated to transfer either cash or assets before the settlement date. Subsequently, if the transaction is not settled, one side of the transaction has failed to deliver. Failure to deliver can also occur if there's a technical problem with the settlement process carried out by the respective clearinghouse. The clearinghouse. The clearinghouse is a designated intermediary between buyers and sellers in a financial market. Every financial market has a designated clearinghouse or internal clearing division. Responsibilities include clearing or finalizing trades, settling accounts, collecting margin payments. That's kind of important for those naked shorts. And regularly delivering their assets. Clearinghouse in the futures market, clearinghouse, futures contract, stock market clearinghouse. Stock exchanges have clearing divisions that ensure the stock trader has enough money in the account to fund the trades. A cleared division acts as a middleman, helping to facilitate smooth transition. Make sure that happens. Okay. I think the clearinghouses need the margin for the FTD, so let's look at it. Failure to deliver is critical when discussing naked short selling. When naked short selling occurs, an individual agrees to sell stock that neither they nor their associate broker possesses. An individual has no way to substantiate their access to such shares. The average individual is incapable of doing this kind of trade. However, an individual working as a proprietary trader for a trading firm and risking their own capital may be able to. Though it would be considered illegal to do so, some individual or institutions may believe the company they short will go out of business, and thus a naked share may be able to make a profit with no accountability. Subsequently, the pending failure to deliver creates what are called phantom shares in the marketplace, which dilute the price of the underlying stock. In other words, the buyer of the other side of trades may own shares on paper which do not actually exist. Chain of reaction of failure to deliver events. Several potential problems occur when trades don't settle appropriately due to FTD. Both equity and derivative markets can have FTD occurrence. With forward contracts, a party with a short position FTD can cause significant problems with the party with a long position. This difficulty happens because the contracts often involve substantial volume of assets that are pertinent to the long position's business operations. In business, a seller may pre-sell an item they do not yet have in their possession. Often this is due to delayed shipment from a supplier. When it comes time for the seller to deliver to the buyer, they can't fill the order because the supplier was late. The buyer may cancel the order, leaving the seller with a lost sale, useless inventory, and the need to deal with tardy supplier. Meanwhile, the buyer will not have what they need. Remedies include the seller going to the market to buy the desired goods, which may be at higher prices. The same scenario occurs to the financial and commodity markets. FTDs are one part of the chain. They can impact participants much further down the chain. During the financial crisis of 2008, failure to deliver increased, much of the same as check kiting, where someone writes a check that has not secured the funds to cover it. Sellers do not surrender securities sold on time. They delay the process to buy the securities at a lower price for delivery. The regulator still needs to address this practice. Pretty interesting, guys. Wow. So this is from Vice, in September 29th, 2021. So it's about 3 months old, but it's still important. Internal Robinhood messages reveal Robinhood executives scramble to talk to Citadel CEO Ken Griffin, breathing life again into theories that two firms colluded to suppress GameStop's stock price. Monday night, Citadel Securities broke its month-long silence on September on Twitter to address rumors circulating in social media that the CEO Ken Griffin lied to Congress about his actions leading up to temporary halting of GameStop and Robinhood in late January. GameStop investment craze was characterized by retail investors imagining they are harming hedge funds and short sellers. I think they were. For months, countless theories and accusations have insisted that Citadel was behind Robinhood's decision to halt trading on the 28th. Countless theories and accusations have insisted that Citadel was behind Robinhood's decision to halt trading on the 28th of January after other brokerages halted trading earlier that week. The central thrust of the theory rests on two relationships that Robinhood received over 35% of its revenue from Citadel, which pays the app for a feed of its users' trades before they're executed, PFOF, right? Payment for order flow. And Citadel helped bail out GameStop short seller Melvin Capital when it started feeling the squeeze. So it helped Robinhood and they helped Melvin. Robinhood and Citadel have denied this theory, including under oath in congressional hearings. A recent round of rumors traced back to a document filed and part of a class action lawsuit against brokerages including Robinhood and market maker Citadel Securities. On September 22nd, the complaint details conversations with Robinhood on the 27th of January. One of the day's trading of GameStop was halted by various brokerages, as well as conversations between Robinhood and Citadel. The lawsuit alleges that January 27th, high-level employees of Citadel Securities and Robinhood had numerous conversations with each other that indicate Citadel applied pressure on Robinhood. Robinhood CEO Gretchen Howard allegedly told CEO Vlad Tenev in Slack that she and other Robinhood executives, including Jim Stotwart, were getting on a call at 5 p.m. with Citadel Securities. Later that day, Robinhood Securities President Chief Operating Officer Jim Stotwart said in an internal chat, "You wouldn't believe the convo we have with Citadel. Total mess. You wouldn't believe the convo we have with Citadel. Total mess." Later that night, lawsuit alleges that the call was set up between Tenev and a redacted person at Citadel. Lawsuit notes that Stotwart's letter stated, "I have to say I am beyond disappointed in how this went down. It's difficult to have a partnership when these kind of things go down this way." Some tension there between Robinhood and Citadel. Allegations coalesced in a hashtag aimed at Ken Griffin. Ken Griffin lied, which gained steam on Monday afternoon when Citadel Securities insisted it did not ask Robinhood or any firm to restrict trading on January 27th. Citadel went to claim it was the only major market maker during this time that provided continuous liquidity every minute of every trading day. Another tweet adds that Ken Griffin and Vlad Tenev have never met or spoken. The firm also tweeted a video clip of Griffin telling Congress he did not instruct Robinhood to restrict trading, adding he did so truthfully. At 2 points in the lawsuit, it mentions that Tenev allegedly requested to speak with Griffin, precisely because the two have never met. Not specific to this crazy issue. The lawsuit does not say that this meeting materialized. In any case, Citadel tweets and this lawsuit document have given new life to a round of conspiracy theories that popped up here and there in the last few months. It's worth knowing that Robinhood disclosed in its S-1 filing for initial public offering that it's currently being investigated by state, local, and federal regulators for its role in the GameStop mess and halt of trading. Still, that hasn't stopped people from speculating, and Citron's return to Twitter only fanned the flame, because Citron's a famous short seller hedge fund. Quick glance at Ken Griffin lied, another hashtag, Ken Griffin to jail, reveals much. Top results reminds readers of 2015, the year Citadel received its market maker status, in the same year as Shanghai stock market banned the company for trading for 4 years over malicious short selling. Others took to mock Griffin and all that stuff. So yeah, that's kind of I mean, Citadel got in trouble with Shanghai and China. They got in trouble somewhere else, I think, because if you can short and distort You can make a lot of money, you know, if you do it right. And then especially if the company goes out of business, like, you know, Toys R Us. God bless Toys R Us. God bless it. It's coming back, though, I think. So, but barely, because some companies, you can't raise cash because their stock price is so low because they got shorted into the ground, you know. Anyway, guys, thanks for tuning in, and I'll see you guys next video. Let's keep on trucking. Later.